Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, September 20th, 2023. We'll start with today's key macro event, which is the U.S. global growth divergence fully priced? So the UK economy experienced an uber dovish surprise in its August CPI data. Headline CPI slowed 10 basis points to 6.7% on a year-over-year basis versus a Bloomberg consensus estimate of accelerating to 7%. And core CPI slowed 70 basis points to 6.2% on a year-over-year basis versus a Bloomberg consensus estimate of 6.8%. The data caused UK money markets to slash terminal rate pricing by 13 basis points today. Now, overnight index swaps only see a 64% chance of a final hike in the Bank of England's tightening cycle. The British pound is flat on the day, despite the news, but it is the worst performing major currency over the past week, down 0.9%, and over the past month, down 3%. So much of today's dovish surprise was priced in. Just getting global currencies to stop declining every week represents a step in the right direction from a global liquidity perspective. Recall that U.S. dollar strength is both a direct and indirect headwind to global liquidity. Asset markets have struggled somewhat this summer for this and other reasons. Refer to our July 28th leadoff morning note for more details regarding this subject, and refer to today's leadoff morning note for more details regarding what you should be doing about this information. So, transitioning to my Bloomberg here, we'll go through our daily rundown of price changes, just giving you a sense of dispersion within and across asset markets. So we'll start with equities here. S&P 500 down 0.7% week over week. That's being led to the downside by energy stocks down 1.9%. You also have real estate stocks down 1.8% as well, diverging from their buddy utilities up 0.8% week over week. In terms of fixed income, we got the Barclays Ag minus 0.4%. It's being led to the downside by bonds. Geez Louise, the bond market. I mean, how many times have we said in the last year, but really since May, been banging the table like a child waiting for SpaghettiOs to get out of the bond market. And I think it's gone down by about 10, 12% really since we started banging that table, but down another 1.5% week over week. Hopefully you're not losing too much money on a misguided recession view that you very much could have avoided had you listened to our research on the Brazilian U.S. economy since going back to last summer. Transitioning to commodity performance, we're at DBC, so that's a commodity index that's up another 0.9% week over week. It's being led to the upside by uranium. We also have crude oil leading to the upside as well. So the energy story is still intact in terms of the commodity markets, in terms of those bull moves that we're seeing in the commodities markets. In terms of the currency market, U.S. dollar up 0.5% week over week. Currency market is still being led higher by the Canadian dollar up 0.9%. And then leading to the downside is the British pound ahead, front running the dovish inflation data that we got for the month of August this morning. And then lastly, in the crypto market, Bitcoin up 4% week over week. The crypto space is broadly up week over week. Solana is actually, Solana's leading the charge, up 7.1% on a week over week basis. And then transitioning finally to my Longbow dashboard to give you an indication of how what the setup is from a trading range perspective across asset markets. Very valuable tool in terms of my toolkit. From a global macro perspective, just looking at dollar, gold, S&P, vol, Bitcoin, Ethereum, Shanghai Composite, crude oil, ag, and base metals. We look at each of these things on a daily basis to give a sense. Okay, what's the setup? What's the next trade? Either risk managing existing bull or bear market, or getting into a new potentially new bull or bear market. And really, right now, there's really no signal. Each of these markets is kind of right in the middle of their trading ranges ahead of the Fed this afternoon. In terms of our thoughts on the Fed this afternoon, you're probably going to see the Fed retain some optionality to the upside with respect to the 2024 dot. You're probably going to see the Fed rein in some of the expectations around policy easing in 2024. And what's likely to cause that is they're probably going to have to positively revise their GDP estimates based on the trends in the data. They're probably going to have to positively revise their core PCE estimates based on the trends in the data. And they're probably going to have to negatively revise their unemployment rate forecast positive for the economy in terms of what that signals for the economy as well. So looking for that dot plot at 2:30, or sorry, Fed presser at 2:30, dot plot at 2. So we'll catch you back here tomorrow. Everyone, Darius Dale, wrapping up our macro minute for Wednesday, September 20th, 2023. Best of luck out there today. Catch you back here tomorrow. Cheers.